Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well, Andrew. Beautiful backdrop, as always.
I keep forgetting that it's actually really kind of damp and cloudy here in London, but thank you for that. Yes, warm thoughts. So kind of let's dig right in. Kind of as expected, this was between the Fed, ECB, Bank of England, all this data coming out. This was a pretty massive, busy week, and the markets didn't disappoint in volatility. So, what was your kind of take on everything that took place last week?
So on the Fed, as I expected, 25 basis points, much more data is needed for the Fed to feel confident about the disinflation. And for the Fed to change the policy path, it would need the economy to move on a different path from the December SCP, all expected. What surprised me was the reaction of the market to Chair Powell's comments or refusal to comment on the recent easing of financial conditions. The market decided that Chair Powell didn't care about financial condition, which I think is a wrong interpretation. I think there is a bit of confusion in the sense that he refused to comment on the recent easing of financial conditions, but he said, and that's factually correct, that financial conditions are tighter than they were a year ago before the Fed started tightening. So that seems to have got people a bit, frantic, perhaps. And so the situation with the Fed, the bottom line remains, the Fed is reactive, has decided to be reactive to inflation prints. And so if I end up being correct and we have a pickup in inflation in the second half, that's when the Fed will get its act together, and it will be too late because inflationary behaviors will be entrenched. And that's when we will need, my 8% and a good recession to bring down inflation, probably in 2024. So I'm more surprised by the markets, in my view, overreacting.
Okay, so like a nuance. Yeah. I thought it was also like he didn't totally rule out cuts later in the year. I thought that was like I saw that,
Well, I mean, you can't, because he doesn't know what's going on. So there is a nuclear war between the US and Russia. I think the hikes are off the table, but what is the probability of that? And that's why, to me, what was important was his frame of reference was a December SCP. He said, to change policy, we would need the economy to evolve in a different manner from the SCP.
That's interesting. Yeah, so the market reacted. We had some. What were your out? Obviously we'll get to payrolls in a minute, but outside of the payrolls, what were any other big data that you were surprised and line? Yeah.
Yeah, I mean, I was puzzled by the services IMF, the services PMI, in December, and so the recovery, which shows that December was a complete outlier, made me more confident that my view on the economy are correct, and also more confident that this survey data has become really noisy and has to be underweighted relative to the hard data.
And then obviously, so payrolls, everything that happened.
Yeah.
Is there a good reason to explain this away? Because it was such an outlier. I don't know if people are saying it's a 3 or 4 standard deviation that, print. But.
So obviously the size of the payroll had to do with the annual data revisions that the BLS does, in January. But it doesn't mean that it was not real. What I think it showed is that the labor market was even stronger than people thought, because what the BLS found is that employment is actually 800,000 workers higher than they thought. So the bottom line is that number will likely get revised down, but it was so large that it's not going to get revised down to such an extent that suddenly it would make us think the labor market is weakening. I mean, that's absurd. Think of the other data set we have, like the JOLTS. We have quit rates that are higher than before the pandemic still, and layoff rates that are lower. Think of the unemployment initial claims below the levels of the...
No, I mean, the claims numbers.
No, but it's... When the data is confusing, what you do is you try to find independently put together data sets and see if they give different signal, and they all point at the same thing.
Yeah.
So yeah,
the number. We did have stuff earlier in the week. I'm just looking through, like it was almost like a tale of two weeks. You know, when if employment cost index that was weaker than expected, which I think was a kind of a big deal. So that looks like that's coming down.
And by the way, I had said I expected the ECI would come in below expectation, but it's 10 basis points. I mean, again, it's important to focus on the forest and not try to count the trees, because we'll get lost in the counting. And the story here is that we have a general move down of prices and wages.
Yeah.
Which again,
for now, right? Yeah.
Is exactly what I expect, given what's going on with energy prices.
Okay, awesome. And then just if oil goes, you know, comfortably and stays below $70 or $65, would that change any of your views? Or
for my views to change, you would need oil to go to 50, you know, or below 50,
and stay there,
because it really is a story about high inflation and the correlation between energy and core inflation when we are in a high inflation regime. So if, you know, by a miracle, energy prices would go down to 40, 50, oil prices, wow, I mean, we'd get the soft landing. I just don't think it's likely, but it's not impossible.
Yeah, okay. And then obviously payrolls and Friday and the market reaction. Do you think, were you surprised by any of that market reaction or no?
Oh, I don't know what to think of the market anymore. No, well, I mean, the market reaction, it lifted the Fed fund rates trajectory, equity sold off. There was a bit of a bear flattening, so more inversion of the curve. To me, this is logical. I just don't think it's going to last, because I don't see inflation prints going up from here. I think that until we have had several months of steady increases in energy prices, we're going to continue to see this low to sliding down inflation print, and that's going to reassure the market. So I bet you that in 10 days, when we get the CPI and core prints around 30 basis points, I bet you that after that print, all the worries about, you know, the Fed not cutting as the market expect, all these will have been priced out. In a way, the Fed is like, the market is like the Fed. They just, you know, they are very literal, very driven by a short-term inflation print, and there is not much obvious thinking behind, you know, what's driving those prints.
Right. So the market reaction from Friday was maybe potentially another hike in the spring, but still cuts further on that still will have this.
Well, there were fewer cuts. I think you had about 22 basis point increase in the December 2023 Fed funds rate, so about one cut taken off in the December print.
Yeah.
And you had half a hike added to the May Fed funds.
Yeah.
So that, I think, is a sort of a shock reaction. Yeah. But I just don't expect it to last.
To last. So sorry, for CPI, you expect it to come out basically in line.
Yeah.
And the market will react how, you think?
And the market will say, inflation? What inflation? We were worried for nothing. And they will put back the two cuts they had the deck 2020.
This and obviously this looks fairly volatile, but the productivity number was pretty strong. I guess it came out on Thursday. Does that mean anything? Like
it's one of those data points that is in the Bloomberg Echo calendar because it's been there since the 1970s, but doesn't have much predictive value anymore. So one of the things that chagrins me because I, have to talk about it and I'm not sure there's much meaning. There can be much meaning to what I am saying. So.
Right. Okay, so market-wise, your kind of overall view is the market was right to react to this number like this, but the market will most likely lose that.
Exactly. I thought for once the market was showing some rationality, but I don't expect the rationality to last. What does the Brits said? The triumph of hope over experience or something. I just don't think the rationality will be there for much longer.
So not coming up with an exact rate, but your general view is something where you would probably sell volatility in interest rates, maybe even equities for the next 1 to 2 months, but you want to own volatility or optionality 6 or 9 months from now when
I would say this is not a time to go long volatility right now. I would do it closer to mid-year.
So your idea is you like owning. That's what I'm saying. You'd almost short vol or be neutral now, and you don't want to waste that vega and time decay when you think that the real fireworks are not now. This is not the beginning of real fireworks. You more think it still will come in the next 3 to 6 months.
And we'll see the fireworks, but with what happens to energy prices.
Okay, cool. Let's move ahead. And I guess the big thing for the coming week is Fed speakers are back out. Will be back out full force. I guess both kind of staking their different claims.
Yeah, I mean, so as I said, their approach to policy making is incredibly risky. And I will be looking for signs that the doves are becoming aware that, they could be sowing the seeds of the next deep recession for the US economy. So we had Dali on the roller on Friday, and, she wasn't at all swayed by the NFP. NFP? What NFP? I'm joking. It wasn't that bad. But she said that basically it didn't change the Fed strategies, that they would stick to the December SCP.
Right.
So
that's roughly now that's 1 or 2 more 25 hikes, and then wait.
It's 2 more by the end of the year, and as I said, no cuts.
No cuts. Yeah.
The economy behaving as I expect. So we have a great number of speakers. Chair Powell obviously is the most important one, but I would also pay a lot of attention to Governor Cook, because she's probably the most dovish FOMC participant. And so this is going to give us a sense of, how dovish the Fed will remain in the face of mounting evidence that overheating is getting worse, not better.
Amazingly, yes. Okay, cool. So there's data which we can go into, but the big thing is sorry, Powell, I think, speaking Tuesday.
Yeah.
Is that an important speech, or you think why would he change from what he said on Wednesday?
So first of all, it is always an important speech because he's a boss. And no, I think I have a suspicion that Powell probably thinks my way. But remember, the administration has stuffed the FOMC with Uber doves, and so as a chair, he has to reflect the views of everybody on his committee. He cannot ignore the doves. And so I suspect, he might give hints, but the bottom line is he's going to probably stick to the party line we need the economy to clearly show that it's moving away from the December SCP in order to change policy. And that applies to the upside and downside.
Okay, and then data, any big data you're looking for this week?
So our listeners will be relieved. I was relieved to see that we have only second category data this week, but still, I mean, one data point that I think is very important is consumer credit, and it's important in two ways. First of all, the boom in consumer credit we are having just shows that Fed tightening is not biting. I mean, it's the data. I don't know what else I can say to convince people. And then, of course, consumer credit is helping, plays a big role in supporting consumption, 70% of the US economy. So that one is really important. Otherwise, trade balance, we're seeing a small improvement, in part because we've had manufacturers, especially of chemicals, relocate from Europe to the US, which has triggered a transatlantic spat. I mean, obviously, they are relocating to the US because they can get energy without worrying about someone like Putin sitting on the side of the tap. And also you have all these juicy government subsidies. So the trend should be for a small improvement. Then we have the University of Michigan Consumer Confidence Survey. But again, I mean, those surveys have become so decoupled from hard data. To me, this is not as important data piece as it was. And then the jobless claims on Thursday, but it's not going to change very much. So the most important one is consumer credit.
Okay, awesome. Well, this has been great, and obviously we're helping to attempt to make sense. And again, the numbers are playing out a lot as kind of as you thought. Any last words for our investors, clients?
No, I mean, we will get also a bit of comments on the debt ceiling, but I mean, don't worry, we're going to get little news until we get close. Nothing will happen until we get to late May, when we are close to the day when the US government runs out of cash.
As we like to do, I'll just give a quick summary of some of the stuff that, say, for our professional clients, some of the pieces we put out. Henry put out a very interesting piece unpacking ECB and Bank of England. Obviously, there's two big central banks in Europe, and somewhat going down different paths or certain messaging. That's an interesting one. Rates Weekly, now written by basically a new partner and kind of new welcoming to Mustafa to the Macri family. Why we favor US 5-year tips. Dominique Dwor and the team putting out the Central Bank Monitor, which has been a really popular thing, and people, if they haven't been reading it, it's definitely worth reading. Gives great insights. For our Prime listeners and viewers, the Prime Trade Ideas that came out on Friday, how to outperform at this point now, at least when the Fed seems to be slightly cooling more than central banks like the ECB, what trades to put on. John Tierney certainly played out on Friday, equity view, why we don't really trust this rally. And Delvira had a great piece on the 3 big trends in DeFi, which is a super interesting piece. Just want to thank everyone, as always, for having us be part of your weekend or early morning Monday. And as always, for any of our clients, please feel free to reach out. And we wish everyone the best of luck.
Yeah, good luck, everybody.